Massive EPS miss for AECOM, ticker ACM. The Q3 2026 earnings results are in, and, well, it is a bloodbath on the bottom line. Revenue came in at $3.59 billion.
Which, I mean, that actually crushed analyst estimates of $2.01 billion. Right?
Exactly. It crushed the estimates, even though that top-line number is technically down 14.2% year over year.
Yeah.
But the EPS, negative 50 cents. That misses the consensus estimate of a $1.46 by a staggering $1.96.
Yeah, and management, they just took a hatchet to their forward-looking numbers, too. They slashed full-year fiscal 26 adjusted EPS guidance down to a range of $3.95 to $4.15.
Wow.
Right. That is a steep, jarring drop from their prior outlook, which was, up around 5.90 cents to $6.10.
So unsurprisingly, the market reacted immediately and aggressively to that. Shares tanked 7.3% in pre-market trading, hitting a 52-week low of about $67.93. Yeah, brutal. So for you, the retail investor, tuning into this deep dive, here is the core discrepancy we are going to tear apart today. How exactly does an infrastructure consulting giant beat revenue estimates by over $1 billion, but still managed to swing to an $84 million net loss for the quarter?
Well, to figure that out, we really have to look at a singular, disastrous legacy project that is basically acting like an anchor on the entire income statement. We're talking about a $337 million pre-tax charge.
And that's directly tied to a construction management project bid back in 2019, right?
Yes, exactly, 2019. It is a staggering number to swallow in a single quarter, and it's the sole reason AECOM posted a $76 million operating loss.
Right, and CEO Troy Rudd, he specifically pointed the finger at poor subcontractor productivity on the final phase of this project. But, I mean, a project from 2019 should be firmly in the rearview mirror by now.
You would think so, yeah. They originally expected it to be substantially complete in the first quarter of fiscal 2027, and now they're pushing that out to the end of the second quarter of fiscal 2027.
Which just bleeds cash every single day. Yeah.
Oh, absolutely. When you peel back the layers on subcontractor productivity, you start to see how these costs compound exponentially. In a massive infrastructure build, everything is perfectly sequenced.
Right, it's a domino effect.
Exactly. If the subcontractor pouring the concrete footing is delayed by a month, the steel fabricators cannot start. The electrical contractors are just, sitting idle.
But the general contractor, in this case, AECOM, they still have to pay for site security, heavy equipment rentals, and project management overhead for every single day of that delay.
Yep. You have 7 years of accumulated inflation on materials and labor eating away at a bid that was priced in a pre-pandemic 2019 economy.
It's just a nightmare scenario. Yeah. And the damage is not just hitting the income statement. I mean, looking at their 10Q filing, the balance sheet is flashing some massive warning signs.
Oh, you mean the contract assets?
Yeah. The claims recorded in contract assets and other non-current assets, they have ballooned to approximately $680 million as of March 31st, 2026.
Which is wild because just last September, that number was sitting at around $400 million.
Right. That is a $280 million surge in unresolved claims tied up on the balance sheet in less than a year.
And, contract assets balloon like that when a company incurs costs on a project. They bill the client or the subcontractor for those overruns, but then the client disputes the charge.
So the money is spent, but it's just sitting in limbo as a disputed claim.
Exactly. AECOM has to record it as an asset because they believe they are legally entitled to claw that money back. But clawing back hundreds of millions of dollars takes years of arbitration and, legal wrangling.
Years of it, yeah. And whenever contract assets inflate that aggressively on unresolved claims, the legal sharks just smell blood in the water. We are already seeing multiple law firms announcing securities fraud investigations.
Oh, yeah. On behalf of shareholders who got completely blindsided by this EPS wipeout.
Now, management is defending themselves by pointing out that this project was bid under previous leadership, with far looser risk controls. They are heavily emphasizing that they walked away from pursuing design-build work for public-private partnership clients in their ACM business years ago.
Right, to avoid this exact scenario, because the structural risks of those public-private partnerships, those P3s, they are immense.
How so, exactly?
Well, in a traditional fee-for-service consulting role, you design the bridge, you hand over the blueprints, collect your margin, and move on. But in a fixed-price design-build contract, you are legally bound to deliver the physical asset at a locked-in price.
Regardless of what happens to the supply chain or labor markets.
Exactly. You eat the cost.
So it's kind of like buying a flipped house. The inspector tells you the previous owners fixed the foundation, and the property is totally de-risked.
Right, a clean slate.
Yeah. But a year later, the basement floods, destroying the HVAC system, And the contractor just shrugs and says, well, that was a 2019 concrete.
That is the perfect analogy.
But here is my pushback. If management claims their internal risk controls are so tightly locked down today, why is a 2019 contract still blowing a $337 million hole in their balance sheet?
Because that flooded basement comes with a massive long tail of legal liability. You cannot just cancel a multi-billion-dollar P3 because management changed its corporate strategy. You are contractually obligated to cross the finish line.
You're trapped.
Yeah. Even though AECOM stopped bidding on new fixed-price construction projects, these legacy contracts carry lingering execution risk. You cannot just write off the risk in a boardroom. You literally have to pour concrete, bend steel, and build your way out of it until the physical handover occurs.
So we are stuck with this flooded basement until at least the second quarter of fiscal 2027. But look, a single delayed construction project does not explain how they still managed to crush revenue estimates by over $1 billion.
No, it doesn't.
To generate $3.59 billion in a single quarter, the non-construction side of the house must be carrying an immense amount of weight.
It really is. I mean, if you strip out that $337 million charge and look purely at their underlying design business, you actually find a remarkably healthy, aggressively growing operation. Excluding the charge, underlying design net service revenue, or NSR, grew 5%.
And breaking that down geographically, the Americas design business grew 6%, while the international segment, which, had been pretty sluggish recently, finally returned to growth at 4%.
Yeah, and a massive driver of that international growth is coming out of the UK, specifically the Great Grid Upgrade project, alongside sustained infrastructure strength in Australia.
The UK's Great Grid Upgrade is actually a perfect example of what the modern AECOM does.
Completely. They are not out there digging trenches for this grid. They are providing the high-level environmental assessments, the complex route planning, and the permitting strategy to modernize an entire national power grid.
It's highly technical, deeply specialized intellectual property work, which obviously carries a significantly better margin profile than managing a muddy construction site.
Oh, night and day difference. Excluding the CM charge, AECOM raised its adjusted EBITDA margin guidance to 17.4%, which is up 60 basis points.
Looking at their trailing 12-month adjusted operating margin, again, excluding the charge, it sits at 16.9%. That absolutely crushes the peer average of 15.4%.
They are squeezing way more profit out of every dollar of revenue precisely because they are leaning into advisory roles rather than physical execution.
Now, that sounds fantastic in a vacuum. The classic corporate spin, right? If you ignore the massive loss, we actually made a ton of money.
Sure, yeah.
But looking strictly at the core design and advisory business, a 5% net service revenue growth rate is barely hitting the bottom of their own long-term target range of 5% to 8%. Why should a retail investor get excited about a company that is scraping the absolute floor of its own growth projections?
I get that, but it comes down to the quality of that revenue, not just the sheer volume. AECOM is executing a structural evolution right now. They are migrating away from traditional civil engineering and shifting heavily into AI-enabled design and high-margin advisory roles.
Specifically targeting complex environments like data centers and hyperscalers.
Exactly, because advising a hyperscaler on a massive new AI data center is a completely different universe than designing a highway overpass.
Right. These hyperscalers are trying to stand up 100-megawatt facilities. So AECOM is coming in to consult on the massive power draw requirements, the localized grid impacts, the advanced liquid cooling systems.
And the Byzantine zoning regulations required to actually build these facilities. They are trading the volatile liability of physical construction for the predictable profitability of design architecture.
Because when you are the lead technical advisor for a tech giant spending billions on server infrastructure, you command premium pricing.
Yep. That structural pivot is actively insulating them from the messy, low-margin risks dragging down their legacy business.
And the market demand for that specialized advisory work is clearly showing up in their backlog numbers. Backlog surged 13% to an all-time high of $27.8 billion.
Which is just a massive number.
Right. And that is being driven by a 1.6x book-to-burn ratio across the entire business and a scorching 1.8x book-to-burn ratio in the Americas.
And just to contextualize that 1.6x metric for a consulting firm, it means for every dollar of revenue they recognize and burn through in a quarter, they are signing $1.60 in new contracts.
Wow. So it provides incredible multi-year revenue visibility.
Exactly. The sales team is stacking up new, high-margin advisory work significantly faster than the engineering teams can even execute it.
Okay, but a record $27.8 billion backlog makes for a great slide in an earnings deck. And the narrative around high-margin hyperscaler advisory work is very compelling. But we need to talk about the actual cash hitting the bank.
Yeah, the cash flow.
How does all of this translate to future guidance? Because there's a severe, almost violent clash happening right now between Wall Street's reaction to the guidance and management's internal confidence.
Wall Street is heavily penalizing them for the immediate cash flow reality because management slashed their FY26 free cash flow guidance by a full 25%. They brought the projection down from approximately $400 million to approximately $300 million.
Which is a massive psychological blow to the investment thesis because it completely breaks AECOM's historical streak of 100% plus free cash flow conversion.
Yeah, for years, this company has prided itself on its asset-light model. The golden rule for a premier consulting firm is that every single dollar of net income should easily convert into at least $1 of actual free cash flow.
And this legacy project charge derailed that core metric entirely.
It did. Now, management was transparent about the lingering headwinds causing that cash flow drag. They noted slower anticipated new project starts in the remaining construction management business.
And they also cited the ongoing conflict in the Middle East as a continued headwind persisting through the fourth quarter. And of course, we are strictly reporting management's stated business impacts regarding the region, purely from a financial perspective, as it remains a noted drag on their international growth targets.
Absolutely. But, while the Middle East and legacy construction segments are dragging, the defense pipelines are absolutely exploding.
Oh, big time. The Department of Defense pipeline is up roughly 30%.
And this isn't just a domestic phenomenon. Canada's defense pipeline is up significantly, too, directly tied to major government mandates to upgrade military bases across their Arctic and northern regions.
And engineering military installations in the Arctic is incredibly specialized work. You are dealing with melting permafrost, extreme weather logistics, and sensitive environmental impacts.
Right. Consulting firms are not building the missile systems. They are engineering the radar foundations to survive extreme freezes, designing specialized runways for heavy military transport.
Managing the environmental compliance. It is a highly technical niche where AECOM has significant pricing power.
So you have this massive divergence between the near-term cash burn from the legacy projects and the long-term pipeline strength in defense and data centers. And it has completely fractured analyst consensus.
It is a bloodbath in the research notes. Baird downgraded the stock to neutral and aggressively cut their price target to $73. Bank of America cut their target to $81.
And Zacks Research went nuclear, dropping them all the way down to a strong sell.
But why are they so bearish if the backlog is hitting record highs?
Because the analyst community is looking strictly at the next 3 to 4 quarters. They have to model the immediate future, and the immediate future involves pumping the water out of that flooded basement.
Right.
The next 12 months are going to be heavily weighed down by the financial cleanup of this 2019 contract, and Wall Street has zero patience for a broken free cash flow conversion streak.
But wait, here is the ultimate counterpunch to those analyst downgrades. SEC filings released right after the earnings call show the CEO, the president, and the CFO are all aggressively buying up AECOM shares on the open market with their own money.
Yeah, that is a huge signal.
We have Wall Street analysts slashing price targets and declaring the stock a strong sell. And at the exact same time, the top 3 executives are aggressively buying the dip. Who is misreading the room here?
It is a battle of timeline horizons. Wall Street is inherently short-term focused, reacting to the immediate 25% haircut in free cash flow. But the executives are playing a completely different game.
Because they see the underlying data.
Exactly. The CEO and president are looking at that record $27.8 billion backlog. They're looking at the 30% pipeline jumps in defense and the massive influx of hyperscaler advisory work.
So they are buying based on what the cash flow profile will look like in 2028. While the analysts are dumping the stock based on what the balance sheet looks like today.
Precisely. The insiders are betting that once this disastrous legacy construction project is physically completed and handed over in the second quarter of 2027, the underlying pure-play, high-margin advisory business will finally be unmasked.
They know the transition from a messy, concrete-pouring contractor to an elite, AI-enabled design consultancy is rarely clean.
Right, but they are confident in the profitability waiting on the other side of that 2027 finish line.
Bringing this all together for you, the retail investor trying to make sense of this quarter AECOM right now is truly a tale of 2 very different companies sharing the same ticker symbol.
It really is.
On one hand, you have a highly profitable, structurally evolving design consulting firm that is capturing premium, high-margin work with hyperscalers and the Department of Defense. They are outperforming their peers on underlying operating margins and stacking up an unprecedented backlog of intellectual property work.
But on the other hand, that pristine, high-margin consulting firm is temporarily trapped inside the financial wreckage of a legacy, fixed-price construction management contract from 2019.
And until that physical asset is completed, the headline earnings numbers are going to remain messy, and the free cash flow will continue to suffer.
Definitely.
Which leaves us with a much larger, critical question to ponder. And not just for AECOM, but for the entire sector. If a single 2019 project bid can suddenly detonate and cause a $337 million pre-tax loss 7 years later, consider the wider infrastructure space.
Oh, it's a terrifying thought.
How many other publicly traded engineering and construction firms are sitting on supposedly de-risked legacy public-private partnership contracts from 2019? Contracts that 7 years of inflation, supply chain chaos, and subcontractor delays could suddenly turn into multi-million-dollar liabilities overnight.
Yeah, that is the million-dollar question.
Make sure you follow the show for daily earnings coverage.